A very good morning and welcome to a new edition of the Grey Market Talk with Thorsten, a retired market maker who's desperate to pull the trigger on something exciting, and something exciting happened this week. That's why I have Nick, the magnificent portfolio manager, asset manager, and man of culture, persuaded to join us from his well-deserved holidays while he's enjoying the opera at an undisclosed location to sniff a little bit into Mozart. I'm a bit jealous about that. Nick, thank you very much for your time. And I want to really spring it on you. We probably are not going to discuss it too long today to not keep you too long away from your fun entertainment. But China, or as Mr. Trump used to say, President Trump used to call it China. I was going through video after video, through articles, news clips, everything that came out in, well, how would we call that, what just happened? Because in my mind, there were several notions, because I'm a little bit older, just as you are. And is that the end of China, like it was the end of the Soviet Union? Or is it just a storm in a teacup? Just to repeat what happened, obviously, we had Evergrande declaring Chapter 15, not 11 in the United States, which I thought was very, very clever, because that means if Evergrande owes you money, you can't use the American courts to say, oh, they have some assets in the United States, I'm going to take that. The assets in the United States are being protected. So the black penny is again with the investors. And then we had Market Garden, not as large as Evergrande, but 4 times as many housing units in B and C cities, how they call it, for the smaller wallet. Which means a lot of Chinese people must be massively being pissed off at the moment that they're not getting their properties delivered. And the thought that came into my mind immediately was, I read an article years ago by Mr. Gorbachev, and he was asked, how did you know, Mr. President, that the game was up? And he said, when I became head of the Central Committee, or whatever the official title was, the first discussion we had for 4 hours, he said, was that we're running out of pantyhose. And the interviewer was a bit amazed. What do you mean, running out of pantyhose? Yes, there were we, the most powerful people in the Soviet Union, discussing that we are unable to provide pantyhose to what we called the middle classes. And that made a little bit of a connection in my head where I thought, okay, China lifted 400 million people out of poverty into a middle class. And now there seems to be some sort of a rug pull. What implication does that have, Nick? Am I overexcited about what's going on, or is it really just, okay, just a bankrupt? China has fiddled. They've stormed very many crises. They will navigate this crisis as well.
Well, firstly, I think they will navigate this crisis, but I mean, it is a big crisis. Yeah, this is, the biggest, explosion in an asset class, for a very long time. So they're still suffering, and it just goes to show. It's like 2007, real estate blew up in the West. Real estate is blown up in China. Are you hearing me, by the way? Because
I can hear you. Your face is a bit frozen, but
my
you
signal. And this has consequences. And what they've got to do clearly is to reflate, and that means they have to be very serious about this thing. The whole thing, I think, is complicated because they have next week the BRICS meeting at a time where their currency is having issues, and where their economy is having issues. And at the same time, they're also trying to convince everybody to take the yuan as a medium of exchange. So, they need some stability there.
I read this earlier, that 80% of household wealth in China is bound into property. 80%, which is an enormous figure. 30% of the whole GDP is related to property, and 2% of the GDP overall is coming out of the building and construction sector. So that is an extreme biggie for me. If I consider that there was this, I've written the name down, this so-called shadow bank, which was also mentioned. You probably know what I'm talking about. Changqi, if I mentioned that correct. It's, how would you call that, an asset manager or somebody who takes people's money and promise them a pyramid scheme to give them twice the returns they would get on government bonds, something down that line. There were phone calls by the police in China to investors in this company telling them to not show up at corporate headquarters and demonstrate. There were pictures on the internet where they built big fences around the headquarters because they obviously remember what happened 2 years ago when Evergrande slipped into this situation. And as I said, we're both old enough. I remember, was it 87? I was visiting my father in Berlin when Tiananmen Square happened, because people didn't want to, well, take what the Communist Party decided for them at face value anymore and simply started a trial balloon. Can we go on the streets? You're still there? You're frozen. Now I can't hear you. You're frozen. Okay, maybe I can feed in the meantime till you're coming back online. The viewers with the data, I had it here. Real estate is key for China. It's 75% of total household wealth and 30% of GDP. Families pool together multi-generational wealth to afford homes, which have become completely unaffordable at 36 times the average annual income. This is an old figure. All the sources I read at the moment is that people, the average median income in China or income earner has to fork up 50 times their annual salary to buy a medium-sized or a median flat. Just to give you an idea, how much do you pay in London? 12, 13 times, 15 times maybe. In Germany, it's roughly around the same, 10 to 12 times. America is cheaper. So the whole dynamic out of this, we mentioned it on this channel a long time before, that Japan, the opening trade ain't going to happen, and that deflation is the big problem when they drift into this cycle. As a father, as you are, I'm more worried about that this could really result in something really, really nasty, because that's what commies seem to do when they lose their power. Am I exaggerating here?
No, I mean, obviously that's a risk, but I'd see that if you look at Taiwan, I saw an article recently that people worried about war and what the Chinese would do and so on and so forth. You look at the Taiwan real estate market, that's just boom, boom, boom. And it's highly unlikely that people will be so positive about real estate if they thought there was a war coming on. So, on the one side, I would say that doesn't appear to be the issue. But on the other side, this whole growth thing and the implications on global growth is significant. And, let's face it, what the Chinese do not want to have is a destabilized economy. And what they've always spoken about, recently focused on, is stability. And if they don't get stability, they've got 1 billion people who are, potentially at risk of knocking on somebody's door saying, we are not happy. So therefore, they have to do something. And like everything, if you have to do something, you will do something. And that, we know the recipe for that. That is to support the market. That is lower rates. That is pumping money into the system. That is, creating bad banks, good banks, and so on and so forth. It's a process, and it has to be done.
So it's the classic playbook. Let me ask you a question, because you're well known for creative solutions. You helped the Japanese to halve their budget deficit if they will only do what you recommended. So China, what do they have? They have a problem. They could become into a deflation spiral. Never good. Yeah, will kill the economy. At the same time, they can print their own money. Yeah, they want to reinflate their economy. They also, well, even though exports came down by 15%, I think, they are still the workbench of the world. They could export deflation, what the inflationary West will actually desperately need, into our countries. So where am I wrong to say just, put the printing press on, let the yuan collapse, flood your people with money and sort this problem out? The only guys losing are the guys who say, oh, yes, we are interested in a stable Chinese currency. Well, you ain't going to get it, but at least you get what China always was, the motor of global growth. Am I wrong here?
We've always spoken about, the risk of devaluation of the Chinese currency. Yeah. That's always been on the cards, and it's more so now than it ever has been. But at the same time, we are looking at the same problem ultimately for the US. So if the two of them are smart enough, they'll do it at the same time, and no one will know, because both currencies go down against other things like commodities and the like. I mean, it's part of the other solution. I would say the classic playbook is the way that we would all look at this thing, and I think that's the way that they are also looking at solving the problem. But there is the other playbook, and that is what happens after at the BRICS conference, or what is it that they are trying to engineer in terms of a new world? Creating a euro out of the Eastern world is not necessarily the great savior. I mean, it hasn't been for Europe per se, but there has to be something else. And one of the ideas put forward by Luke Gromen already for some years now is to price gold and oil at a different ratio than where they have been. And effectively what that will do is sort of reprice gold, let's just say double, triple what it is. The Russians effectively sell gold to the Chinese at a different ratio. The Russians lose, on the one hand, their oil, but on the other hand, they gain on the revaluation on their gold reserves. And that would give them more wealth than even the money that was taken from them by the West at the time of Ukraine. So ideas like this are also kind of discussed by analysts, and it wouldn't surprise me if something somewhere down the road does happen like this. And I think that will be another step forward. But for now, with a classic playbook, they've got to do something which is, provide solutions for broken companies, put liquidity, reduce interest rates on mortgages, say they're going to support the property sector, give people some hope. Because if property prices are falling by 20% and you say people have to pay 50 times their earnings, well, I know what I would do. I'd say, well, it's not stopped going down, is it? So I won't buy anymore, and I'll just wait. And I think they need to put a kind of a floor on prices through their policies. And I'm sure they're scratching their heads, very hard right now, because this is bad.
That brings me to a good question. What's the implication? They're sitting still on a bunch of treasuries, and they've started selling 3-4 months ago, flooding it slowly into the market. That is a big asset. And now we are seeing 10 years almost at 4.25 or something, or even intraday above these levels. Could there be coming more material out of China just because they have to sell?
Well, put it this way. If they make a decision on letting their currency go, then they'll let their currency go without supporting it by getting rid of their treasuries. If they want to support their currency because they want to stop the flight of money, which is, leaving China still, even though they have capital controls, then, if they really do believe that if by stabilizing the yuan, they'll stop the exit of money, I don't know. I doubt very much where that is. Then that is a huge risk for the US, and it would explain what's going on with weakness in the 10-year at a time when the yuan is declining in value, because that's not normally the relationship.
Jeff Snyder had an interesting take on that, actually, on the interest rates. He said interest rates are not high. They are far too low for what we are seeing here at the moment. Now, the market is actually, the bond market, even at 4.25, or as Bill Gross said, it would be fairly valued at 4.5 on the 10 years. The market is actually pricing already in the bond market a recession. At the front end, we have what do we have? 5.5, 5.25. And now at the long end, we are only, he said, at 4.25. What we are seeing right here now is not the indication that we have this fantastic soft landing or no landing at all. What we see in China, and he put it very bluntly, a term I actually will steal from my students. He said, what happens if China can't trade with India or trade with Germany? Then Germany doesn't make any money to invest in India, so India will reduce their production. They can't trade with China anymore, and the whole world collapses into this potential depression. or recessionary/depressionary environment. And that's why interest rates are at the level where they are at the moment. They should actually be higher if the complete narrative, everything is fine, should be at far higher levels than they are at the moment. That is a good indication what we are slipping into. And now for me, it's just what we see in China now. I don't really know how a totalitarian regime will fix this problem without going through a lot of pain. I think that is the right word. And a lot of pain will be most likely be imposed on us as well in this scenario.
You stole that word from Powell, pain, the pain trade, possibly. I don't think so. I don't think the Chinese basically say, oh, you know what, we've got a deflation, let's just sort of let things collapse over the next couple of years, see what happens, and then sort of pick up the pieces at the end. I don't believe that. I think all governments, if they want to stay in power, even a totalitarian regime, if they want to stay in power, then they will do something to keep power. And the only thing they can do is reflate. I think that's the realistic best solution. And I think going down the other route, selling treasuries and delaying the problem is one thing. But we talked about it a long time ago. The solution to all of this is the dollar. So you weaken the dollar, you reduce the problems around the world, you give the Chinese the chance then to actually provide reflation for their economy without having to worry about their own currency collapsing. And for that reason, it's in the interest of the Americans to avoid the Chinese from selling their own treasuries to support their currency. So instead, who's going to buy them? Right, because that's just not the game plan anymore. People are sort of looking at their own currency, so it has to be bought domestically. And the only rationale to buy it domestically is if you see a recession on. So that's like a double whammy. Why would you want to do that? So you've got to engineer a lower dollar, and then that for me is a much more of a global solution, and one that would work for the Chinese and one that would work for the Americans as well.
Now we had two administrations, President Trump and now President Biden, who at least officially do not like China. So I'm with you on your analysis, but is it realistic to expect the Americans to help the Chinese actually to stabilize their currency when they're in such a big pickle? Or do they say, okay, where do we cut our losses here? China is... we are bringing the production chains back into our countries, what Trump started. I think Biden is not against that either, because he's a Democrat. He wants to have more workers in the United States because they vote for him. Chinese people don't vote for him. Could they actually say, yes, we take a walk on this tightrope and let the Chinese, let them suffer a bit? They caused Corona, still didn't admit to it, that it generated in their country, and now we just turn it around a little bit and say, let's stand on the sidelines for a while and let them cope with their own problems. It's not as if they have excessively friendly to the West in recent times, and their collaboration with Russia is also pissing off everybody in the Western world who are on the side of Ukraine or NATO.
Possibly. I'm not a geopolitical analyst, and my tuppence worth in this thing is that everything I've heard from administration officials, and that's, they always tell you what they want you to hear. It's not necessarily what they may believe, but I don't hear anyone saying we can go on fine without China, and whatever happens over there, we don't really care. I don't see that. I mean, everything I'm hearing is everyone needs everyone else, certainly for now. Everyone will do what they can for themselves, which means, in the long run, I can envisage people being forced to buy their own government bonds, and there'll be less reliance on international funding, so that the Chinese will over time get rid of their treasuries. And even in, why would the Europeans even sort of buy treasuries, frankly? I mean, they would also want to keep their money locally. So I can imagine a world in the future where people say, I'd go and buy my own stuff. But I think a world today where you say, well, let this, just let them fall, would have dire consequences, because then you'll get into, a different type of financial war. And then you will say, China will say, okay, you want to do this thing on your own? Here's your trillion of treasuries. And oh, by the way, we own a lot of other stuff, and create another financial turmoil, in my view, in the West, and one which I don't think the West is prepared to deal with right now.
What are the implications for the shorter term now? Let's talk tactical. We still call it the tactical brief here. Implications on the US market, because I thought, we have companies, for example, Volkswagen, who are heavily dependent in their profits on China. Then you have Tesla, heavily dependent on China. Then you have Nvidia bringing numbers next week, Wednesday evening, heavily dependent on China. When does the market realize we have, and I'm not quoting Jeff Snyder now, the opposite, we have a market at relatively high interest rates. China is looking a bit wobbly. Everything is pretty much possible at this point in time. And we had now maybe the first indication of a couple of weekdays in the markets. And markets as well as I do, the information is always there. People have seen it for weeks. It's right in front of their face. Nobody reacts to it. And one morning, everybody has a look at, I don't know, zero hedge and realizes, oh my God, we are really in trouble here. I better go and sell fast. Are we in at least a short-term correction period for the markets, which was induced by the China troubles we had coming up now, or is it still too early to give a call there?
Okay, I mean, what actually induced it, who knows? My signals turned bearish on stock short-term on the 1st of August. So, but the long-term signals are still bullish. What that means is this is from an Elliott wave perspective, from signals perspective, from a liquidity perspective. Liquidity was falling. You showed me some charts as well. Liquidity is coming down. It wasn't going up in line with where the markets were. We said that we'd passed the point of recognition, the point where everyone who was bearish in the past to turn bullish again. So we had this sort of bit of everybody who was, the guys now stopping themselves out. All of the perfect storm that created without China, right? Without China, a storm that created, a profit taking in the stock market. Stock market still, in my view, is in a reasonably good shape. This is still a bull market. It's an expensive market. I mean, we talked about that as well. So if I was going to buy equities, where would I buy them? I wouldn't be buying them necessarily expensively in the States, even though I still believe that we'll get new highs in stocks. Interest rates now are even interesting. But even I've been bearish. You said you like the 10-year. I said I wouldn't buy them right now. There's more chance of getting 4.5%. I didn't hear Bill Gross's number at that stage. He's picked 4.5%. I said roughly 4.5%. It could be about right. Could be that we stay around here. It doesn't really matter. The point is that, there are going to be a lot of investors still who believe that, with this kind of equity risk premium being so low versus bonds, well, maybe I'll ride it out for a couple of years, go and buying some bonds, whether it's 2 years, whether it's 5 years, even more sort of people who are bearish on the markets and going out to the 10-year looking for that recession. At least you're getting paid for it now. You weren't being paid before, right? But one thing is for sure, I'm not so comfortable in the idea of, you talk about tactical. I'm not so comfortable with the idea of these 60-40 portfolios where the bond portfolio is going to bail you out the equity. What if they continue to go in line, that yields continue to rise in an environment where stocks continue to go up? And I think that's actually still quite feasible until the point comes where the authorities say, actually, we do need to cap that yield because we cannot afford high interest rates in the States. And we know that interest rates have to be peaked in the next few years. There's no way this higher for longer for, we're going to stay at 5% for 2+ years. Forget that. You can't afford that. So the Americans have got just as much problems as the Chinese, except the good thing for the Americans is they've got growth. And we talked about recession last week. You said, where's my recession? I said, well, you're not getting it because the amount of money coming out from the government is just, and there's still so much money flying around from COVID times. You know, that's not. That's why the economy is still okay.
Yeah. No, I
GDP
totally agree
now
with
from
you.
the Antifa.
On the terms of portfolio construction, I just wrote an article which will be published, I think, in October at the Verein der technischen Analysten Deutschlands, so the technical analysts, e.V. And it reminded me of a time when, in the olden days, when we had interest rates, and I was the trading boy called into a meeting where a large Dutch pension fund wanted to give our old firm a mandate to manage a huge amount of money at the time. And you know the game as well. You had portfolio managers, researchers, analysts, and they also had to produce some guys from the trading side just to show initiative. And our head of research made this beautiful presentation, and the head of portfolio management as well, about the process and how careful we are with everything. And you know, the real due diligence pitch, safety pitch. You have probably heard millions of those in your time. And it was a hot day, and I'm giving the article away, the two Dutch boys took their jackets off, and you saw red braces. Yeah. And I thought, oh, that's not going well, boys. These guys want something else. Yeah. What they wanted was actually, and I tell you the acronym I created for that later, they wanted a portfolio where they said, listen, we know the problem. If I'm not invested all the time in boring stocks, a classic 60-40 portfolio, when I'm counting on the hedge to work, it most likely doesn't do it. And in the meantime, I'm being rewarded with mediocre returns. We don't like that shit. What we want to do is we want to pile all our money into high beta stocks, yeah, whatever we choose, play with this, be invested all the time, but we want to hedge our tails out. So if something really bad happens, we want to have a tail hedge, which might us even overcompensate. The rest is actually calculation. So the classic portfolio where you take this into consideration, as you just described, yeah, there might be new highs, and you want to be invested in the stocks or in the asset which offer a high return. At the same time, you're not stupid. You want to have a nice tail hedge that actually works in this case. I called it the Ferrari blow and hookers portfolio. Or protocol, what they wanted. We came up with more nice sounding acronyms for it later. But this would actually be the approach. As you mentioned, the 60-40, I'm looking into at the moment as well, to say, yeah, fine, I don't know what's going to happen. I want to have a tail hedge. We have now interest rates. Interest rates allow me actually to put more hedge on than I was able to do before. Even in terms of, retailers love that capital guaranteed products. You remember that 20, 25 years ago, big craze. Because on a 5-year portfolio, you had the 5-year zero bond was trading at, I'm exaggerating, roughly 80. So you had $20. You could play around in options. Fantastic. And you would still have your money reserved. So that is my take on this portfolio construction side at the moment, where even though I'm bearish, I would be going with you. At the moment, my straddle is still doing fine because we bought the volatility relatively, well, almost at the low point. Barely ever happens. But hey, that's where we are. And I see the point as well. Short term, obviously, this whole China thing is, I think, could become a psychological point from next week on. We have huge gamma short positions in the market as well. And people forget what works on the upside also works on the downside. So shorter terms, I had a conversation with Marcos yesterday on our German string about NVIDIA and stuff. And I said, well, you know what? I'm not worried if I miss the last 5% to the upside, but don't have this huge skewed risk that I might lose 50, 60, 70% on my portfolio. Yeah, blame me in half a year time if you made an additional 10% and then you lose 80. Pretty much the situation we heard from all our fellow retail colleagues in the 2000s. Oh yeah, I know when to go out. You never knew. It's always this, I know when to cut my strings, and then they never do it. So that's my short-term assessment at the moment. I'm still having an eagle eye on the Chinese situation, because with this political power, the time also has changed. You know, when the Soviet Union faltered, China was friendly. China needed us, we needed China. There was just one big bloc, and they had the luck to have Mr. Gorbachev there, who was a reasonable guy. Now, if you think a little bit further back, when did President Ping actually, or President Xi, how would you say it, are actually started concentrating the power again under his whole control? It started 2.5 years ago, didn't it?
About that.
Yeah. That's when Evergrande was in the making. So obviously he has the real numbers, which we don't get. Did you hear that? The 20% youth unemployment in China. They've just stopped publishing the figures. China came out and said,
yeah,
we don't like that, so we stop publishing them. Brilliant. We should do the same.
I mean,
all over the place.
It's too late because the last one was high enough.
Well, it almost sounds.
But also, I mean, global economy realistically isn't firing on all cylinders, right? That is the truth. People are not happy. We've got this sort of move towards the extremes of politics everywhere. China is a big one though, and China, we talked about it for a while now. It's starting to get into the public eye, and we, as I say, I'm one to say, let's see what comes out of BRICS, what other solutions they are going to come up with in terms of creating a future for part of the world, and see whether or not that is supportive. Maybe that's what they're waiting for before they announce their own policies. I honestly don't know. But China is it's not one, in my view, for people to just say, okay, let it go and we don't care, because it's not just Tesla who will suffer and Bosch or whoever else, or sort of BASF who invested over there, or Falvey. It's also Raytheon. Raytheon CEO has said, we can't make the stuff that goes bang without the stuff that we get from the Chinese. So, and he got lots of shit for that, but it's true. So the world needs each other, and I think realistically they'll come up with a solution. They won't just let it go, in my view. And by the way, it's not just the Chinese who own treasuries to support their currency and start dumping their treasuries. If the Japanese thought the Chinese were dumping treasuries, they'd be in there as well, because they've got the same amount. Yeah,
China used to be the biggest. Now it's Japan again, right? Because China has already reduced. Well, we have now a very, very interesting scenario right up here. I like these things. The one thing that you can be sure of, I think, famous last words, I don't want to be volatility short at the moment, under no circumstances.
Yeah, I mean,
in currencies, nor in commodities, nor in equity markets, not even in bond markets. It's a weird scenario where we are going into. Maybe I can finish on that note to leave that with our viewers to think about it. While researching China, I came about a video published by the BBC a year ago, and the question was, Evergrande, obviously, was that China's Lehman's moment? And if you watch it a year later, you think, no, it was their Bear Stearns moment. Lehman is just around the corner, so better fasten your seatbelts. That went on for a while. When Bear Stearns folded, we had 5 months before the real disaster started to happen. And I think then would be a good time again to have a closer look at China, but they first have to sort that out. It wasn't their Lehman moment, otherwise things would be looking far nicer now. It was their Bear Stearns moment, and now they're about to maybe experience their Lehman moment. Nick, I want to thank you and want to ask you any last words on our deliberations, because then I let you have be the witness at the, at the Figaro's wedding?
Indeed. No, I've got no comments. I mean, bond market is kind of interesting here. It's sort of in that area where I thought it would go. So I'm looking at that to see if there is actually a turn here or slightly higher in yields. I think that'll be quite important. As I say, it's good for a trade, but it's not necessarily great for an investment for the future, in my view.
Right. Thank you very much for taking the time, even in your holidays, even doing something nice, spending the time this morning with me. And Well, let's see what happens during the week. NVIDIA will be interesting. Probably everybody expects huge swings. Probably not going to happen anything. Volatility is extremely high. I'm setting up a little trade recorded for the German side to just show everybody what could happen and what can't happen. That might be quite interesting. And we'll have a discussion next Sunday again. Thank you very much, Nick.
You're welcome. Enjoy.
Bye.
See you. Bye-bye.